This is John Kirby back with the Bear Trap podcast. I just thought I'd make a little bit of a quick update because I was seeing some confusion on Twitter regarding, not just Twitter, also in the Discord and stuff like that, regarding why implied vols on the monthly and weekly ranges seem to be kind of low right now, especially compared to 0DTE. And then also in regards to debate, that has to do with swing trading in this environment, right? So something I wanted to point out is that this hasn't really been the case as much earlier this year. So let's say that you had tried swing longs on 313 here, like I'm pointing out with the cursor. And then, yeah, in theory, maybe you could have gotten lucky and rode them all the way up to 410. Like these seem like pretty intuitive ranges. But if you look at the intraday ranges, right, on 313 itself, we have a range from 389 all the way down to 380. That's a 10-point range. There's yet another day here with a 10-point range on the 16th. And then here's another one with a 10 by 10 point, I'm saying like 10 handles on SPY, so like $10, right? Another one right here. And then it's worth noting that as we're looking at these this is a weekly auto expected move, so it takes the options market and tries to figure out basically what's our 1 sigma for that week, right? And these are remaining relatively static, but the range of actual volatility, of actual realized volatility, is clearly compressing if you look at it from the perspective of open to open, right? Or close to close for a given day, whereas the intraday ranges are huge. They're tremendous, right? And this is a little different than earlier in the year because earlier in the year we had much clearer trending, at least as far as I'm concerned, right? Whereas here you can clearly see that there's this range compression. Honestly, ever since February, you're starting to look at this sort of very intense range compression here with a couple of really big days, but mostly it's just killing your further dated options. So yeah, I basically what I wanted to say is that this is an environment that's created in order to trade 0DTE or trade intraday. And this makes a lot of sense from an institutional perspective. I mean, not only have we seen 0DTE option buying go off the charts, but or buying and selling volume in general go off the charts, but also we know that the players in 0DTE options are not just retail, in fact, predominantly institutional, especially as selling options is concerned, right? And then you can use intraday margin in order to do that. And there is a little bit of a loophole where, especially if your margin is calculated by the end of the day, you can kind of get away with a little more intraday. So there's a big advantage. This is kind of a longer explanation, but right, like when you're trading with a broker, any sort of broker, then a lot of times margin requirements are set for that broker by the clearinghouse, right? So we retail often have a broker and then the clearinghouse. A lot of times, if you're institutional, especially if you're a market maker or something like that, you're dealing directly with clearinghouses, and a lot of clearinghouse. There's a lot of different ones actually, and their margin requirements are not set on, and they're not set up for being intraday. So not only do you have something that's called or is quite similar to portfolio margin, where you can use positional deltas to offset other positions, right? So you can be long, and if you're long and short, then those deltas can offset each other and they lower your overall margin requirement. But on top of that, oftentimes your margin's only calculated overnight, really. So there's this kind of loophole that's going on where a lot of institutions, a lot of larger players are actually using 0DTE. And this is something that, Jim Carson has mentioned as well, where he says, hey, realized vol this year has outperformed implied vol. And what he means by that is if you're able to have leverage for a very big move intraday, think about like trading Bitcoin or something, just like futures, right? Like buy or sell with a very intense margin, then that's actually going to pay out a lot better than a situation in which, like, let's say you buy puts and the market crashes, implied vols are actually not rising on a consistent basis because every single time all these different players are either buying or selling 0DTE options, right? There's just more activity there. There's a bigger rush for the exits as soon as a position plays out, right? So I'm in 0DTE puts, the market moves against me. It moves with me. In other words, it moves down, and I make money on those puts. Implied vol rises somewhat. Well, I know that everybody else is going to be rushing to get the hell out of those puts by the close, right? Because there's an insane amount of theta decay on them. So actually, I want to be the first to that party and get the hell out, right? Similar with calls, a little bit less the case with calls, and I think that's part of why we're actually seeing this sort of grind up. I've been thinking about it, and I know I commented on a previous podcast that a lot of the reason for this move up is the so-called resolution of the banking crisis, increase in overall liquidity. But most of that excess liquidity went to lending between banks, right? It didn't necessarily hit the economy, so it's not as if it's plunging directly into the markets. And if it is, then it's just going into money market funds because there isn't a lot of money coming into the markets right now. There are not significant inflows. But it did represent a little bit of a risk off in speculation, right? That rate hikes could be over. So when you get that in conjunction with this sort of 0DTE dynamic where, to put it really bluntly, it's easier to go up than it is to go down because there's an implied vol squeeze on the way down. Whereas if you go up, not so much. We're essentially just pinging between gamma nodes. And that is... it's kind of fun for those of us who are intraday traders. It's really kind of unfair for anybody who is a longer term, swing trader or even an investor, anything like that. But it's just something to keep in mind, right? And that doesn't mean this is going to last forever. It means it's very likely that when this dynamic breaks, it's going to be especially problematic. And that's something that Jem also mentioned, right? If we get a 6% move, we'll get a 10, 11% move. So also something to keep in mind. But hey, don't buy tail hedges, because if you buy tail hedges, guess what's going to happen? We're just going to continue to grind. You'll get these massive intraday ranges, but if you stay in your position, you're going to get completely ground out until it finally happens. And that could be 6 months from now. It could be a week from now. It could be a year from now. We have literally no idea. So this is actually, it's a very interesting and fun market dynamic. It's a little insane. And... but if you understand it, right, and I think, and hopefully, if you've been listening to the podcast, you'll kind of understand what I'm talking about, then you'll know how to trade this type of action way, way better. Yeah, that's mostly what I wanted to say for this update. I'm trying to think about if there was anything else notable. Oh, yeah, so this big squeeze, right, that we got on, actually, where was it? It was here on the 31st, the JPM collar squeeze. I was doing a little bit of research, and I actually noticed that... it seems like participants are getting a little smarter about 0DTE because, so to go back to that day, what happened was JPM, right, they had that short call strike at 39.65 SPX, not SPY, but it doesn't really matter for these purposes. I'm happy to switch over to SPX if that makes things easier. Okay, there we go. Anyway, they had that collar right there. 40.65. Yeah, so it was right here basically. And actually what happened was a lot of these institutions I was talking about, over the course of like a few very large transactions, they came in and sold 40.65 puts. And that makes dealers need to get net long deltas. And what it is, it's actually a very, very smart bet, because what you're saying is, well, either we pin the collar or we squeeze. Again, remember, that JPM short strike there, those are short calls from JPM's side, right? So essentially JPM is short the market at 40.65. So any transactions that happen that push the market higher than that, that's taking money away. It's squeezing JP Morgan, and they're not really going to do anything except roll into the next caller. What you do have, right, are market makers that are actually also long the market at that point. They're most likely delta hedge, but they actually are probably slightly long upside gamma, right? Which means that they're fine with having a squeeze. They're totally fine with it. And so this was completely the move. It was, hey, sell those 40.65 puts. If it pins, you make all your premium. If it squeezes, you make all your premium even faster. And then as soon as people start to pile into the 4100s, which they did, you pile into those too, and then you just ride the squeeze. And so another thing I want to mention is just I'm seeing some participants actually get significantly more clever about how they're playing these intraday 0DTE gamma squeezes. So that's also something to keep in mind, right? We're kind of, this has always been sort of a game theoretical enterprise, right? Trading. But the game theory is now playing out in terms of what I would call positional analysis on an intraday basis, which is very fun for those of us who have been doing it a lot. But for those of you who, how would I put it, are more interested in using trend lines, investing on longer time horizons, swing trading, that sort of thing, things are going to get a little weirder and a little more confusing. Anyway, that's the entirety of this update. Just wanted to put something out so that you guys know that we're watching, we're thinking about this. And it's been a while since the last podcast too, so there is a lot of different videos coming soon. Just FYI. So subscribe, like, all that stuff, and I'll keep you posted. All right, bye bye.